Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. It's Monday morning and the government is still shut down.
And the market is still rising. Go figure.
Here we are. Let's get to the biggest stories right now in the more than $18 trillion global ETF industry. Stocks surging at the start of a very busy week for earnings, with SPY nearing another record high.
Plus, there is no slowing down the hyper-leveraged ETF race, even as some participants stumble. And this time, a filing for funds offering 5 times the daily return of some of the most volatile assets out there. One of the biggest players in the leveraged fund space joins us, Sylvia Jablonski, CEO of Defiance ETFs. She will also discuss their new AI Power Infrastructure Fund. Now, Eric Balchunas of Bloomberg Intelligence is off once again this week, so Katie is doing the honors and looking at flows. What have you got?
Sources tell me he'll be back next week, but we can only pray. Let's take a look at where money went to in the week that was. This is interesting. Right at the top, you have tech stocks and you have gold. The Q's taking in a cool nearly $6 billion at the same time that you have GLD taking in another $4 billion. Down below, VU, IVV, SPY there as well. That's your S&P 500 exposure. So a lot of money going towards equities and into gold. Let's take a look at where money was coming out of. And this is a name that I really haven't seen at the top of the leaderboard very often. This is JAAA. This is the Janus CLO ETF. We know it has been on fire for years now, but it lost nearly $500 million in the week that passed. That isn't quite a record, but still a large sum coming out of JAAA. Then you have SQQQ. This is leveraged inverse exposure to the Q, so still bullish to see this type of flow. Let's take a look at the overall picture, though. I love this chart over here. We've been talking a lot about record launches in the ETF space. You're seeing record flows as well. So far in 2025, U.S. ETFs have taken in $1 trillion. You take a look at the past record set in 2024 of $1.1 trillion, Scarlett. We're not even through October, so we're well on track to surpass that record.
All right, that's a great setup here for our conversation, because I'd like to welcome now Ben Slavin. He is global head of ETFs at BNY. And Ben, volatility has picked up. We saw the VIX get to 25 on Thursday. There's a rotation to safety. Gold is going gangbusters. U.S. Treasury yields are down to multi-year lows. The S&P 500's best performers this year are utilities and healthcare. How are ETF flows reflecting this, what seemed to be increased skittishness?
First of all, I think flows are just incredible when you think about shattering that $1 trillion mark. It's just kind of hard to get your mind wrapped around. So we're seeing flows across almost everything as far as the ETF structure is concerned. But certainly we are seeing some clients that are looking to reposition themselves, and certainly some of the products that offer some downside protection, and also some fixed income products that are going to the shorter end of the curve as well, especially given where rates are looking to head going forward through the end of the year and into next year.
Well, that's the thing, Ben. I think it's so interesting that at the same time you're seeing so much money shoveled to just, equity exposure. You still have a lot of money going into GLD, as we just showed, also into sort of those short-term cash-like ETFs. It's hard to make sense, for lack of a better term, the fact that you do have this really risk-on appetite at the same time where it seems like people are reluctant to give up or even stop going into maybe those more haven-like ETFs.
Well, you're seeing a little bit of everything. Again, you are seeing some of that risk-on trade, of course, in the flows that we see. But also, again, there is some conservative positioning. I think on the short-term cash products or money market-like ETFs, certainly some of that is a structural play. It's investors looking to rotate out of money market mutual funds and maybe pick up a little more yield on some of these products and really serve as a replacement or an enhancement to what they're already doing, to that $7 trillion we're seeing and growing into those money market funds to date.
The debasement trade was all the talk about 2 or 3 weeks ago, this idea that people want to de-dollarize or de-risk their portfolios, go into gold, go into Bitcoin, anything to get away from U.S. dollar assets. But you look at Bitcoin over the past weeks, and it's really struggled since that weekend sell-off. How is this affecting the release of new products tied to crypto?
It's a great question. Look, again, from a ETFs industry standpoint, we are once again at a record. That's kind of been the headline of this year. Over 800 new products launched. And certainly crypto is one of those sort of aspects of the industry that is seeing a lot of product development. There's more than 100 pending filings with the SEC. and we do expect those to continue to come out. These are for both spot crypto, different asset types, but also different variants that are giving investors more choice, whether it's crypto with yield or crypto with downside protection or leverage crypto. I think we're going to see a little bit of everything, even despite backing off its all-time high. The appetite for those products is continuing to grow.
Well, Ben, speaking of the SEC, something amazing happened in the past couple of weeks where we finally saw the SEC give the green light specifically to Dimensional to launch ETF share classes of their existing mutual funds. Dimensional has, of course, gotten that okay. We know that there's been a whole raft of applications from the ETF issuer landscape here. I'm curious where this goes from here. Now that we do have the initial okay, the blessing from the SEC, there's a lot of concerns as to whether the plumbing of the industry is able to handle this. And I wonder where you fall on that question.
This is the multi-billion-dollar question that everybody is asking. So look, it's very disruptive and it could be a game changer, but we think this trend is going to take some time to really play out. And I think part of it is really that infrastructure, or plumbing, if you will, to be able to facilitate all of this. First of all, just getting all these products to market, but also the process in which all of the asset managers need to go through to figure out what does make a good ETF share class, because they're not all created equal and not all funds make sense as far as having an ETF share class attached to it, but also just the platforms and the ability to actually process what we anticipate will be a number of exchanges coming from the mutual fund into the ETF. And again, that's going to take some time, and there's a lot of automation and technology that needs to be built to facilitate it. So huge trend, but it will take some time to play out.
So earnings season is now in full swing here in the U.S. We saw big banks surprise to the upside. Regional banks had some credit, concerns that popped up. And now it's the start of tech earnings season with Netflix, Tesla, and Intel due to release in the coming days. How big a trading event are earnings for an ETF crowd that's increasingly got more complex tools at their disposal?
I think in some ways, like, you see the trading volume continue to spike, and especially what we've seen the last, this year and really the last quarter, ETFs have been bouncing around between 30 to 40% of the market volume. Incredible to think about how much volume and, how investors are actually using these products to position around earnings. And it's just giving investors more choice. So now you have the single stock ETFs. You have leverage versions of those single stock ETFs, up and down. But also the ETF structure is, as you know, transparent and allows investors to look through to understand what assets or what stocks are in these products so they can position their portfolios accordingly and play those earnings. And we see literally a little bit of both, or a little bit of everything, when it comes to ETF investors and looking forward to earnings. And certainly we see that in the tech sector.
Well, we'll be talking about leveraged single stock ETFs in just a minute. But Ben, before we let you go, it's exciting that it's earnings season because we're not getting official government data on where this economy is. Maybe corporate America can fill in the gap. But with the government shutdown, I'm curious about what the implications for the ETF industry are, whether or not this has any bearing on the record pace of ETF launches that we've seen so far year to date.
There doesn't seem to be much of anything that's slowing down ETF these days, but maybe the government shutdown could play a little bit of a role. It's just effectively going to cue some of these new product launches that need SEC or government approval to be able to get to market. And when you see that, again, they're not going away, they're just sort of queuing quietly in the background. So we anticipate when the government reopens, certainly there will be a spike in those new product launches, especially headed into year end, where we would anticipate, again, a historically busy season to get new products to market. And here we go once again. They're stacking quietly behind, but ready to go.
All right, good stuff. Ben, really appreciate your joining us. Ben Slavin of BNY. We do have some headlines coming out from President Trump. He's talking about how he is going to be discussing Taiwan with Chinese President Xi Jinping when they meet in Korea. He did say that he thinks they will get along with when it comes to Taiwan, and that they'll end up with a strong trade deal with China. Some soothing words from the White House, of course, helping to underpin the gains that we're seeing in equities this morning. We will continue to keep you posted on further developments. You can see right now President Trump speaking alongside the Australian Prime Minister at the White House.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with an interesting filing from BlackRock. BlackRock is planning for a floating rate ETF just in time for the Fed to lower rates. We know, of course, that floating rate securities have had a wonderful time as the Fed has hiked rates and then kept them there. But of course, it could be a strange time to launch one of these products. We'll have to see how this goes. Ticker and expense ratio not yet listed. Let's talk a little bit more about gold. We talked about this when we were looking at Go with the flow, but just to highlight again how strong demand has been for gold. You saw holdings rise once again in October at a slower pace, but still that is a lot of green bars that are accumulating to the right of that chart. But Scarlett, let's end with a proposal for a 5 times leveraged ETF from volatility shares. Remember, we were discussing 3 times leveraged funds, those different filings that we've seen land from a bunch of different issuers. Now you have volatility shares trying to push the limits once again with a 5 times leverage here. We'll have to see, of course, if this launches. The SEC is caught up in the government shutdown, so I don't know who is around to say no.
Yeah, it's a good question because we had the blow up, I think a week or 2 ago, of the triple leveraged inverse ETF that tracks AMD. This was in Europe because triple leveraged ETFs don't exist in the US yet. So it's pretty remarkable that you've got a company now looking to launch, or at least filing for a 5-time leveraged ETF.
Yeah, absolutely.
I'm not sure I can understand the thinking there, but.
Yeah, this one, so it would, basically volatility shares, this is one of these issuers that likes to test these limits. They have single stock funds tracking Tesla and Nvidia. They also have some Bitcoin in there as well. So, I mean, they have some experience with this, but certainly after we saw that product in Europe blow up, maybe it raised some eyebrows, but as Athanasios told us, it probably won't deter investors. It probably isn't going to deter issuers.
Absolutely. I mean, everyone's kind of very single-minded in terms of looking at just what's in front of them. Let's talk about this a little bit more with Isabel Lee, who wrote the story for Bloomberg News about this. And Isabel, we're just saying how in contrast to Europe, the U.S. doesn't even have 3 times leveraged single stock ETFs, much less 5 times. Has that changed? Have the rules changed on us?
So no one knows. Katie and I are in the same IB chat, and when this came in, we were all shocked. We thought it was a typo because when this 3 times actually made waves, you were like, this is insane, kind of crazy. And then you see this 5 times. So we were like, what happened to 4 times? So you just jumped to the 5 times. But then in Europe, these are already available, but none of them track single stocks. They just track indexes like the S&P, the NASDAQ, and even the Magnificent 7. But if you think about it, if a stock or an underlying moves 20%, if it's 5 times, what will happen? And this tracks Bitcoin, Ether, at least the proposed filings, and all the volatile stocks you can think of, from AMD, Strategy. So it's very exciting to be in the ETF space right now.
Well, talk to us about how the government shutdown sort of factors into this conversation and whether or not anyone is around to say no, say yes. What does this possibly look like?
We're in day 20 of the shutdown, and that's what some people are saying. I mean, these aren't proven, but some speculators are saying maybe that's why they're trying to slip it in. Because some are also saying that once they submit, if everything is going well, within 75 days, this will launch. Unless something is gravely wrong, but it seems like they know what they're doing. So that's also one thing. But we've seen the SEC with PRIV, even if the ETF becomes effective, they can still have the power to say, no, we don't want it, and write a cease and desist letter or anything like that.
One thing that you mentioned in your story, which I think is important context, is that leveraged funds have actually been posting outflows over the past 3 months. So it feels like we've reached, saturation, or there's fatigue with these products?
There could be, because when you look at the retail investors, people look at them as a monolith, but there are layers. And for a while, they were piling into crypto, they were piling into options, and then for a while, they were piling into leverage ETFs. And maybe now they're getting tired of it. I mean, now there are auto-callable ETFs. I mean, those are just filed, but it's just one high-octane product after the other. Maybe it's just a blip, those 3 months, but then it was interesting to see red, because usually we just see green on the screen when we run BI ETF or ETF Go.
Especially when you've got the market so near record highs. It's definitely notable.
Optimism is just everywhere, but we'll see.
Isabel, thank you so much as always. Bloomberg's Isabel Lee writing about these proposed 5 times single stock ETFs. Just a little bit nutty, given that 3 times are not even legally available right now. Now, still ahead, we're going to speak with Sylvia Jablonski. She is CEO of Defiance ETFs, who is an executive tied to many of these single stock leverage ETFs. Her firm has a new ETF. It's an AI one that's tied to power generation. We're going to discuss that next. And just a reminder, you can listen to Eric Balchunas and Joel Weber on Trillions, their podcast that covers the ETF industry. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu alongside with Katie Greifeld. Eric Balchunas is off for the week.
And as such, I'm doing today's drill down where we focus on one ETF. In the hot seat today, I'm pleased to say we have the Defiance AI and Power Infrastructure ETF. The ticker here is AIPO. This is an interesting one. Of course, it's really in the zeitgeist of what we all keep talking about. That is AI and how it intersects with infrastructure. This only launched towards the end of July, as you can see, on the 25th of July. So it's not quite a newborn, but still an infant. It's already accumulated about $69 million in assets, so certainly not too bad for a brand new fund. It charges an expense ratio of 69 bips here. This is a passive ETF, so 69 basis points for that exposure here. Let's take a look at some of the holdings when it comes to what actually populates this fund. It's a lot of machinery type names, a lot of electric type names, utilities, as you might imagine. Up top, we have Quanta, Eaton, GE, Vernova, Vertiv. Those types of holdings are what makes up this portfolio, which stands at about 56 names overall. I want to take a look at performance because so far it has been rocking it. It is new. Again, end of July is when it came into existence, but in that time, it's climbed nearly 22% on a total return basis. We compared that to NVIDIA, only higher by about 5.5% in that time. And the S&P 500, as measured by SPY, only up about 5% since the end of July. So it's early days, Scarlett, but so far so good for AIPO.
All right, good stuff, Katie. Joining us now to talk about this ETF is Sylvia Jablonski, CEO and CIO of Defiance ETFs. And Sylvia, this is a passively managed fund, but I look at the holdings, and as Katie pointed out, there are a lot of electric companies, construction companies, and you've got the chip makers as well, like NVIDIA, like Broadcom. What's the thinking behind the chip makers having a lower weighting, 14%, versus machinery companies having about 22%?
Yeah, well, so the thesis behind this ETF is that this is where the puck is going in AI. This is that next AI trade, right? So for anyone who thinks that AI might be crowded, this is where you should look, because it's going to take a lot to power data centers. It's going to take a lot to power the AI revolution. So McKinsey came out and said there will be 6.7 trillion of CapEx that's needed for this, and 5.1 trillion of that is going to be in AI. And it's mostly going to be around energy, renewable energies, you know, electrical grids, the kind of nuts and bolts that are required to power AI. But then the second part of it is obviously chips, right? You need chips to run the data centers. And so we wanted to include that to actually give a pure play for AI and power infrastructure.
And it's interesting to that point to see REITs here as one of your smallest weightings in terms of industry groups weightings that only has about 2%. It feels like a lot of folks have been looking for exposure to data centers and the boom that we're seeing there through REITs, not necessarily this ETF though.
Yeah, and so that's just a small part of this. I would say that the biggest chunk of it is you looked at some of those top holdings in there. You mentioned them like GE Vernova, Quanta Services. You know, these are the names that are actually going to power the AI data centers. They're going to power the innovation behind AI. And REITs are a smaller part of it. I think that they play more into the connectivity part of the equation. And so maybe investors who are looking for that exposure will look there as well.
I need to ask you about leveraged single stock ETFs because that's a space that Defiance is a big player in. And obviously we just talked with Isabel Lee about how there are all these filings for 5 times leverage,
yes.
3 times leverage, when that doesn't actually exist in the US. In terms of how far you can get with those kinds of filings right now, the government is shut down. So
right.
Is there just no response? The issuers are just filing and throwing it out there and seeing what happens?
Well, so to date, a lot of issuers have filed for different products, whether they're single name levered ETFs or other ETFs. And, you know, in terms of what has come to market, a lot of these filings are new. So we still have about 75 days or so before any of the issuers actually have to make a decision in terms of to bring it to market or not. And I think, you know, we're all kind of hoping that we get some SEC feedback and SEC back in office before that happens. So nobody's actually launched anything without the SEC's blessing, to my knowledge.
And we did hear Kevin Hassett on CNBC this morning saying that perhaps the shutdown will end this week. That's a big if, but of course, 75 days is a long time. I am curious, though, you think about the experience of the Granite Shares product that was listed in Europe. That was 3 times inverse exposure to AMD. basically forcibly having to liquidate and delist. And I wonder, as you're putting together these filings, I know there's not much you can say specifically about an active filing, but when you're thinking about new products that you might ask for permission for, seek to launch, how much are you thinking about potential blow-up risk?
Well, I think any issuer that works with levered and inverse products has to think about this, and you have to have a plan for outsized intraday moves that, in your last segment I heard you say, if you have a 20% move in a 5x fund, you wipe out the whole fund, right? So we're very much aware of the risk of the products and the different mechanisms that we have in place in order to manage the product should that happen. And if you notice with the Defiance filings, it's target, right? The word target is in there for a reason. So there may be a day where actions have to take place to preserve the fund for the investor and essentially not wipe out the fund in the event of a sizable move. And so what I would say is most of our peers and competitors have a similar type of strategy in place. I don't think, we're looking to have those types of outsized moves wipe out a fund.
It very much feels like these leveraged single stock ETFs are targeted for retail investors who have taken on, this class of funds with a lot of gusto. But if retail investors go dormant, would institutional investors be willing to pick up the slack?
Just looking at the different trading activity across the levered and inverse funds, yes, there's a lot of popularity in the retail sector, but there is an equal or higher amount of interest and trading that happens in the institutional space, whether it's high frequency traders, hedge funds, ARB desks. It's still very much an institutional play. It has just attracted retail. And what I would say is not all retail is the same. Like there are these very sophisticated day traders out there that are comfortable with leverage, have used higher leverage points with things like futures and ETNs and such in the past. And so, they tend to understand the risks of these products. All of that is very public and out there. And, we want to make sure that those messages are out there too for the average retail investor.
All right, Sylvia, great to get some time with you. Great to kick off the week with you. That is Sylvia Jablonski. She is the CEO of Defiance ETFs. And you can read all about this drill down, plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. There's the promo. It looks great. That does it for Bloomberg ETF IQ, the television show. I'm Katie Greifeld along with Scarlett Fu, and this is Bloomberg.